Acquisition. An acquisition or takeover is the purchase of one business or company by another company or other business entity. Such purchase may be of 100%, or nearly 100%, of the assets or ownership equity of the acquired entity. Consolidation occurs when two companies combine to form a new enterprise altogether, and neither of the previous companies remains independently. Acquisitions are divided into private and public acquisitions, depending on whether the acquiring or merging company is or is not listed on a public stock market. Some public companies rely on acquisitions as an important value creation strategy. An additional dimension or categorization consists of whether an acquisition is friendly or hostile. Achieving acquisition success has proven to be very difficult, while various studies have shown that 50% of acquisitions were unsuccessful. Serial acquirers appear to be more successful with M&A than companies who only make an acquisition occasionally. The new forms of buyout created since the crisis are based on serial-type acquisitions known as an eco-buyout, which is a co-community ownership buyout, and the new generation buyouts of the MIBO and MEIBO. Whether a purchase is perceived as being friendly one or hostile depends significantly on how the proposed acquisition is communicated to and perceived by the target company's board of directors, employees and shareholders. It is normal for M&A deal communications to take place in a so-called confidentiality bubble, wherein the flow of information is restricted pursuant to confidentiality agreements. In the case of a friendly transaction, the companies cooperate in negotiations. In the case of a hostile deal, the board or management of the target is unwilling to be bought, or the target's board has no prior knowledge of the offer. Hostile acquisitions can, and often do, ultimately become friendly, as the acquirer secures endorsement of the transaction from the board of the acquiring company. This usually requires an improvement in the terms of the offer or through negotiation. Acquisition usually refers to a purchase of a smaller firm by a larger one. Sometimes, however, a smaller firm will acquire management control of a larger or longer established company and retain the name of the latter for the post-acquisition combined entity. This is known as a reverse takeover. Another type of acquisition is the reverse merger, a form of transaction that enables a private company to be publicly listed in a relatively short time frame. A reverse merger occurs when a privately held company buys a publicly listed shell company, usually one with no business and limited assets. The combined evidence suggests that the shareholders of acquired firms realize significant positive, abnormal returns, while shareholders of the acquiring company are most likely to experience a negative wealth effect. The overall net effect of M&A transactions appears to be positive. Almost all studies report positive returns for the investors in the combined buyer and target firms. This implies that M&A creates economic value, presumably by transferring assets to management teams that operate them more efficiently. There are also a variety of structures used in securing control over the assets of a company, which have different tax and regulatory implications. The buyer buys the shares, and therefore control, of the target company being purchased. Ownership control of the company in turn conveys effective control over the assets of the company. But since the company is acquired intact as a going concern, this form of transaction carries with it all of the liabilities accrued by that business over its past and all of the risks that company faces in its commercial environment. The buyer buys the assets of the target company. The cash the target receives from the sell-off is paid back to its shareholders by dividend or through liquidation. This type of transaction leaves the target company as an empty shell. If the buyer buys out the entire assets, a buyer often structures the transaction as an asset purchase to cherry-pick the assets that it wants and leave out the assets and liabilities that it does not. This can be particularly important where foreseeable liabilities may include future, unquantified damage awards such as those that could arise from litigation over defective products, employee benefits or terminations, or environmental damage. A disadvantage of this structure is the tax that many jurisdictions, particularly outside the United States, impose on transfers of the individual assets. Whereas stock transactions can frequently be structured as like-kind exchanges or other arrangements that are tax-free or tax-neutral, both to the buyer and to the seller's shareholders. The terms demerger, spin-off, and spin-out are sometimes used to indicate a situation where one company splits into two, generating a second company which may or may not become separately listed on a stock exchange. Extracting technological benefits during and after acquisition is ever a challenging issue because of organizational differences. Based on the content analysis of 7 interviews, authors concluded 5 following components for their grounded model of acquisition. Improper documentation and changing implicit knowledge makes it difficult to share information during acquisition. For acquired firms, symbolic and cultural independence, which is the base of technology and capabilities, are more important than administrative independence. Detailed knowledge exchange and integrations are difficult when the acquired firm is large and high-performing. Transfer of technologies and capabilities are most difficult task to manage because of complications of acquisition implementation. The risk of losing implicit knowledge is always associated with the fast-paced acquisition. An increase in acquisitions in the global business environment requires enterprises to evaluate the key stakeholders of acquisition very carefully. Before implementation, it is imperative for the acquirer to understand this relationship and apply it to its advantage. Retention is only possible when resources are exchanged and managed without affecting their independence. Legal structures. Corporate acquisitions can be characterized for legal purposes as either asset purchases, in which the seller sells business assets to the buyer, or equity purchases, in which the buyer purchases equity interests in a target company from one or more selling shareholders. Asset purchases are common in technology transactions where the buyer is most interested in particular intellectual property rights but does not want to acquire liabilities or other contractual relationships. An asset purchase structure may also be used when the buyer wishes to buy a particular division or unit of a company which is not a separate legal entity. There are numerous challenges particular to this type of transaction, including isolating the specific assets and liabilities that pertain to the unit, determining whether the unit utilizes services from other units of the selling company, transferring employees, transferring permits and licenses, and ensuring that the seller does not compete with the buyer in the same business area in the future. Structuring the sale of a financially distressed company is uniquely difficult due to the treatment of non-compete covenants, consulting agreements, and business goodwill in such transactions. Mergers, asset purchases and equity purchases are each taxed differently, and the most beneficial structure for tax purposes is highly situation dependent. One hybrid form often employed for tax purposes is a triangular merger, where the target company merges with a shell company wholly owned by the buyer, thus becoming a subsidiary of the buyer. In a forward triangular merger, the buyer causes the target company to merge into the subsidiary. A reverse triangular merger is similar except that the subsidiary merges into the target company. Under the U.S. Internal Revenue Code, a forward triangular merger is taxed as if the target company sold its assets to the shell company and then liquidated, whereas a reverse triangular merger is taxed as if the target company's shareholders sold their stock in the target company to the buyer. Documentation. The documentation of an M&A transaction often begins with a letter of intent. The letter of intent generally does not bind the parties to commit to a transaction. but may bind the parties to confidentiality and exclusivity obligations so that the transaction can be considered through a due diligence process involving lawyers, accountants, tax advisors, and other professionals, as well as business people from both sides. After due diligence is completed, the parties may proceed to draw up a definitive agreement, known as a merger agreement, share purchase agreement, or asset purchase agreement, depending on the structure of the transaction. Such contracts are typically 80 to 100 pages long and focus on 5 key types of terms. Conditions, which must be satisfied before there is an obligation to complete the transaction. Conditions typically include matters such as regulatory approvals and the lack of any material adverse change in the target's business. Representations and warranties by the seller with regard to the company, which are claimed to be true at both the time of signing and the time of closing. Sellers often attempt to craft their representations and warranties with knowledge qualifiers, dictating the level of knowledge applicable and which seller party's knowledge is relevant. Some agreements provide that if the representations and warranties by the seller prove to be false, the buyer may claim a refund of part of the purchase price, as is common in transactions involving privately held companies. Representations regarding a target company's net working capital are a common source of post-closing disputes. Covenants, which govern the conduct of the parties, both before the closing and after the closing. Termination rights, which may be triggered by a breach of contract, a failure to satisfy certain conditions, or the passage of a certain period of time without consummating the transaction, and fees and damages payable in case of a termination for certain events. Provisions relating to obtaining required shareholder approvals under state law and related SEC filings required under federal law, if applicable, and terms related to the mechanics of the legal transactions to be consummated at closing, repayment of outstanding debt, and the treatment of outstanding shares, options and other equity interests. An indemnification provision, which provides that an indemnitor will indemnify, defend, and hold harmless the indemnitier for losses incurred by the indemnities as a result of the indemnitor's breach of its contractual obligations in the purchase agreement. Post-closing, adjustments may still occur to certain provisions of the purchase agreement, including the purchase price. These adjustments are subject to enforceability issues in certain situations. Business valuation. The 5 most common ways to value a business are asset valuation, historical earnings valuation, future maintainable earnings valuation, relative valuation, discounted cash flow valuation. Professionals who value businesses generally do not use just one of these methods but a combination of some of them, as well as possibly others that are not mentioned above, in order to obtain a more accurate value. The information in the balance sheet or income statement is obtained by one of 3 accounting measures: a notice to reader, a review engagement, or an audit. Accurate business valuation is one of the most important aspects of M&A, as valuations like these will have a major impact on the price that a business will be sold for. Most often this information is expressed in a letter of opinion of value when the business is being valuated for interest's sake. There are other, more detailed ways of expressing the value of a business. While these reports generally get more detailed and expensive as the size of a company increases, this is not always the case, as there are many complicated industries which require more attention to detail, regardless of size. Objectively evaluating the historical and prospective performance of a business is a challenge faced by many. Generally, parties rely on independent third parties to conduct due diligence studies or business assessments to yield the most value from a business assessment. Objectives should be clearly defined and the right resources should be chosen to conduct the assessment in the available time frame. As synergy plays a large role in the valuation of acquisitions, it is paramount to get the value of synergies right. Synergies are different from the sales price valuation of the firm, as they will accrue to the buyer. Hence, the analysis should be done from the acquiring firm's point of view. Synergy-creating investments are started by the choice of the acquirer, and therefore they are not obligatory, making them essentially real options. To include this real options aspect into analysis of acquisition targets is one interesting issue that has been studied lately. Specialist advisory firms. Although at present the majority of M&A advice is provided by full-service investment banks, recent years have seen a rise in the prominence of specialist M&A advisors, who only provide M&A advice. These companies are sometimes referred to as merchant capital advisors or advisors, assisting businesses often referred to as companies in selling. To perform these services in the U.S., an advisor must be a licensed broker-dealer, and subject to SEC regulation.